the end to cover those, as well as wanted to let you know that this webinar is going to be recorded and will be available on our website later this week or early next week. And then we just also ask that you please keep yourself on mute throughout the presentation so we can avoid that extra noise. And that's all I've got. So at this point, I'm going to go ahead and pass this over to our President and CEO, Mary Rutherford.
Thank you, everyone, for joining us. It's great to see so many of you patching in. I think in light of the current pandemic, we're all doing the best we possibly can in this crazy time, and MCF is no exception to that. You may know that we all began working remotely in mid-March, and we continue to work remotely. Staff are in the office on an as-needed basis, but generally speaking, we're keeping things running. We're just not all doing it from the same location in our offices. And like many of you, we have gotten more and more adept at technology and participating in these wonderful conversations via Zoom. I was telling Omar earlier today, I've been on 4 Zoom calls already today, and I'm pretty much zoomed out. I'm at my capacity, but we enjoy being able to interact with you, even if it's with a Zoom call. So thanks for patching in. Many of you know that the new portal, our MCF portal, is now gone live. You should have received an email from us with registration details, but if you did not, you can still go to our website and click the links there to sign up. It'll be about a day or so, maybe less delay, before Kathy gets you your login and password. But Kathy Cooney is doing a great job of making sure all of you are registered on the portal and using it. It hasn't been perfect, I have to confess. You know, we worked really hard to make sure this process was going to work, and with every process, there were a couple bumps. We did our best to anticipate, but we're really pleased with the new portal. Also coming soon to a computer screen near you, because we're not doing any face-to-face work, unfortunately, will be a new endowment workshop series that will be rolling out over the last week of July, first week of August. So please pay attention to your email. We're going to be sending out invitations to folks to sign up for the endowment webinar as well, to understand maybe a little bit more of the inner workings of how endowments work, how the board policy affects endowments, etc. So pay attention to that if you're interested. And so now, kind of to bring an end to my blathering, I'm happy to pass the baton over to our friends at Cambridge. Omar Sanchez, who I hope you can see on the screen, is joining us. He's our Chief Investment Officer at Cambridge, and he's also, we like to fondly refer to him as our outsourced CIO, providing our investment committee and board and myself with just excellent technical advice and incredible knowledge and abilities. His team do a great job, and we're joined today by Alyssa on his team, who's kind of helping steer the ship in the background as well. So we've been going on this roller coaster ride together, and Omar and his team have done just a really great job of keeping me and our investment committee well informed on how things are performing, what things are looking like, and what we're anticipating. So with that, Omar, thank you for being our partner, and I'll turn it over to you.
Thank you, Mary. And it's great to see everyone. And I know we've done a couple of these over the last couple of years, and I guess this is the first time we're actually seeing everyone on the screen. So that's actually an improvement, notwithstanding the fact that we can't do this in person. But it's good to see you all today. And we're delighted to be here and talk about the really the broader macroeconomic market backdrop, but then obviously, more importantly, how that relates to the portfolio and how it's been performing in a very difficult year, to say the least, for capital markets. So Alyssa, if I could ask you to go to the portfolio highlights slide. This is page 4 of the presentation, if there's anyone on the line that isn't able to see this. And we'll start with the highlights, and then we'll get into the agenda. Starting on the left-hand side in that donut chart, and this is as of May, you can see total portfolio assets were $90.6 million, diversified across the different types of strategies that you see there, whether global equities, private investments, and so forth. If you look at the portfolio snapshot table in the center top table of the slide, you can see that between public equity and private investments, we had roughly 2/3 of the portfolio in assets that are really meant to do primarily one thing, and that is drive growth in the portfolio so that we can grow the portfolio's long-term purchasing power. We have 17% in the portfolio in what we refer to as diversifying strategies. You can think of these as a combination of traditional long-short equity, event-driven hedge funds, as well as some other less correlated liquid alternative strategies. And then the balance of the assets between inflation hedging and deflation hedging, these are assets that are really meant to provide both ballast and liquidity in really the market environments that can be particularly challenging for equities. Really there are sort of two that we tend to focus on the most. One is a period of severe unexpected inflation, so an inflation shock, and then the other is deflation or economic contraction like we've been experiencing and are continuing to experience today. So in terms of performance, the table directly beneath, I'll start with the quarter, start with the good news. We've had a much better start to the second quarter than we certainly did in the first quarter. And I don't think that's probably going to be lost on anyone or a surprise to anyone. But for the quarter, for the quarter, the performance was 10.2% for the first 2 months of the quarter against our policy benchmark of 9.5%. That is a decidedly different outcome than what we witnessed in the first quarter when the portfolio was down on the order of 14%. So while we're looking at a year-to-date return here of about 5.4%, just know that that's a significant improvement from where we were, certainly at the end of the first quarter, given all the volatility that we've been experiencing in markets. And I would also note one of the main reasons that we diversify, not just within our equity allocation and within the portfolio writ large, but also by using different types of strategies, particularly those hedge fund strategies, is to really try to limit the downside that this portfolio experiences. And I'm proud to say that, you know, at 5.4%, we never are happy with a negative return, but that's just under 60% of the equity market downside for the year through the end of May. And that's actually a bit better than we generally target from the portfolio. So from a downside protection perspective, we have been pleased that the portfolio has been holding up relatively well. And I would also note, while admittedly it seems an incredibly long time ago, this comes off a really banner year for the portfolio, certainly on an absolute basis, when we were up about 19 percentage points. And so relative to where we were at the beginning of last year, we are still ahead of the game, if you will, notwithstanding the negative return that we've had in 2020 thus far. So now moving to the upper right corner of the page, performance drivers, both on an absolute and a relative basis. On an absolute basis, clearly our treasuries have contributed to performance, and our TIPS, or our inflation-linked bonds. Really, those are the only assets in the portfolio in this type of environment for the year that have delivered a positive return. And so it stands to reason that they are the primary contributors from a positive perspective. On the negative side, commodities, we had some weakness in the commodity exposure that we have, particularly earlier this year on concerns about oil supply, excess oil supply. There was a lot of volatility in those markets, and that's been a detractor. However, I would note it's a relatively small part of the portfolio. And then similarly, just equity writ large, but in this case, more specifically, emerging markets equity was a detractor on an absolute basis. In terms of relative contributors, positive relative contributors, our hedge funds actually not only have protected capital, they've delivered essentially 35%, give or take, of the equity market downside thus far this year. They've also had a pretty good year on a relative basis, which we've been pleased to see because that has been a more difficult part of the portfolio for sure. And then treasuries, heading into the most acute part of the market sell-off, really February and March, we entered that time frame with a bit of an overweight to treasuries, and so that was a contributor to some positive relative performance that we were able to achieve in the portfolio. And then again, on the negative side of the ledger, US equity and global equity, primarily driven by a handful of more value-oriented strategies that we have in both of those allocations. You may be aware that value is at a particularly challenging year this year, given the types of companies that are typically in a value manager's portfolio, particularly more cyclically oriented companies that have really gotten hammered amidst all this market volatility. So I have an update, at least for June, in terms of where we think we stand today. We think we're tracking through yesterday up another 1.6% for the month of June, which would put the portfolio down about 4% for the year, so a bit more of an improvement as markets have largely continued to move up in June. And that would put total estimated assets as of yesterday at 91.9 million. So now turning to the agenda, very briefly, I wanted to spend hopefully 1, maybe 2 minutes on who we are. For those of you who may have not participated in these calls last year or the year before, I want to talk about our investment philosophy and how it ties to how we manage and build client portfolios. And then, of course, talk about recent market action and our outlook, and then how that relates to how the portfolio has performed, particularly this year. So Alyssa, if I could ask you to go to, yes, thank you, the page 6. So who is Cambridge Associates? We were founded in the mid-70s by 2 gentlemen, Hunter Lewis and Jim Bailey. Initially, their work was focused working with Harvard University to do a research project for them for their endowment. Ultimately, that business grew considerably. And so basically for 45 plus years, what we've been primarily doing is really focusing on finding ways to add long-term value to our client portfolios based on their specific, unique investment objectives. And I think it's really important to highlight the point on alignment here on this slide. We have no off-the-shelf products sold. We think that that's really important in this industry because we often think this industry has a lot of conflicts. And it's really important to us to have no off-the-shelf products so that we can look at our clients with a straight face and say, if we're putting this investment in your portfolio, we're doing it because we think it's the best investment out there and no other reason. So we really think that's critically important to our value proposition. So if we could go to the next slide, Alyssa. So page 7, I used to get haircuts. I don't get them anymore, so my hair looks a lot different than it did there, but you know, such is life. At least I'm combing it. In any case, this is your team, your outsourced investment office. I am, as Mary noted at the outset, the Chief Investment Officer, and I'm supported by 5 investment directors, 1 director of portfolio operations that really handles all the execution of the management of the portfolio once we've made those decisions, 3 investment analysts, including Alyssa, who is on the line driving this presentation, and then 2 performance analysts. And I think the key for you to remember is we have a very robust team, but I think more importantly, or if not equally important, we have a very robust platform that we sit on top of and can leverage. Investment management research, capital markets, risk management, operations, and so forth. And we leverage those resources to build the best portfolio that we can for the foundation and for our other clients. That is something that is critical. So with that, why don't we then shift gears to our investment philosophy. So it's all about a long-term horizon that will likely come as no surprise to you. You know, there can be a lot of noise in the markets. Even today, while there's a lot of scary headlines out there, we would argue that the key to success is to really try to, while at least be aware of it, certainly not make investment decisions based on it, and really try to keep that long-term view. And to do that, you really need to have a plan. You need to have a strategy. And that strategy needs to be based on your, in this case, the foundation's specific willingness and ability to take risk, your risk tolerance. And I want to be very clear, and I try to make this point with all of my clients because I just think it's so important. When we talk about the investment strategy, this is not a strategy that is designed to avoid the next bear market or difficult bear markets. What it is designed to do is allow you to withstand difficult markets by providing different sources of liquidity in the portfolio so that you can continue to draw and do the great work that you do, while not having to sell assets in the portfolio that are likely more depressed, namely the equities that we have in the portfolio. So I like to think of the portfolio that we build for you and for other clients as really a bend but not break portfolio. That's what we're trying to do, because if we can do that, we won't de-risk, we won't have to de-risk, and we can participate fully as and when markets recover. The third point there, active management. We understand it's gotten quite a bad rap. We would be the first to tell you that it's very difficult to do. We'd also be the first to tell you that we believe in doing it strongly when we think we can get paid for it net of manager fees. So when we talk about performance later in the presentation, what we're showing you is all net of manager fees. And I would also note, we are not averse to providing or doing index or providing passive exposure in the portfolio. In fact, we have a decent amount in this portfolio today. It's really not an either or, but an and. And we will do active management when we think there's a good prospect over the long term that we can be paid for it. We are not market timers. We don't believe in really kind of making significant or wholesale shifts in portfolio allocations based on a view of the near-term direction of markets. What we will do, particularly when valuations for asset classes are at extremes, is we will make modest tilts relative to our targeted exposures. So if we think a specific asset class is extremely, extremely expensive, we may underweight that asset class as a way to add incremental value to the portfolio. However, even that type of decision is really more of an intermediate outcome that we're expecting. We're not really trying to be short-term with this portfolio at all. And primarily we're trying to get the bulk of our value added over time from picking great managers. And then the final point on the investment philosophy is risk management. For us, it's not a tool or a model. It's really integrated throughout our process. It's everything from making sure that we've set the right policy that reflects your risk tolerance. It's building a highly diversified portfolio that has different types of exposures that are complementary to each other. It's position sizing so that no one single position determines success or failure. And it's really the ongoing blocking and tackling, the monitoring of portfolios, portfolio exposures and positions so that we're aware of the bets that we're making, and we do everything we can to mitigate any unintended bets that we may have in the portfolio. I do know that there's a question that just came up on the chat regarding socially responsible investing. I'd love to just take that towards the end of the presentation if that's okay, because I do think it's a great question. So Alyssa, if you could go to the next slide. How do we build portfolios? For clients like the foundation that are looking to grow their long-term purchasing power, we believe in building heavily equity-oriented portfolios. If you're going to get the growth that you need to have equities. And so we use both public equities as well as private investments to really drive the long-term return of the portfolio. We then layer in those diversifying strategies to help us reduce risk in the portfolio, to provide ballast, and to do that without ideally giving up as much upside as if we were to just use bonds to do that, because we could just use bonds, but we think over time, ideally, we should get a better than bond return, certainly from those strategies to help reduce that overall portfolio risk. And then the last piece, as I said, is the inflation and deflation hedging positions. That is all about giving us the liquidity, particularly in those more difficult market environments, so that we can use those assets to support the spend that we need to make from the portfolio, and ideally not have to sell equities, or at least sell less equities that are likely going to be selling at quite depressed prices. And I just saw another question come as well on the tactical tilts. I just want to take a quick look at that. What tactical tilts are we anticipating next year? Why don't I come back to that within the context of the market outlook? And I'll certainly ask Teal to help me keep track of questions if I'm missing anything. So the last point that I wanted to take on page 11, if you would, Alyssa, is, thank you, is diversification. No surprise, we are big believers in building diversified portfolios. What we're showing you on page 11 is what we refer to as a quilt. You've likely seen a different version of this, or many different versions of this perhaps. What we're showing you are asset class returns by calendar year for the last 20 years, essentially, with the best performing asset classes towards the top and the worst towards the bottom. We're also weaving in an equal weighted portfolio, so a portfolio that holds all of these assets, as well as our average client return. The equal weighted portfolio is the gray box in each of those years. The average client mean return in each of those given years is the more teal colored box. Really 2 points that I would make on this exhibit. The first is, as you can see, asset class performance can and does rotate quite significantly year to year, and today's best performer could be next year's dog and vice versa. And so we think it really doesn't make sense at all to really load up on a handful of asset classes, but rather try to diversify that exposure across several. Because if you do that, then I can get to my second point, which is we think you can get a more consistent return over the long term. And you can see that when you look at that equal weighted portfolio or the Cambridge client return, that generally tends to hover kind of in the middle there, if not a bit above median. The point being, we think you can get more consistent returns. Will you get the best performance every single year? No, but we're highly confident that you're not going to get the worst either. And over time, particularly if you look at this on an annualized basis, you will do quite well. So with that, why don't we then shift gears and talk about markets. So first, I'll just, again, tell you what I'm showing you here on page 13. We're showing asset class returns for the month of May, as well as those same asset class returns for the year to date through the end of May. And I guess what I would say is a couple of things. Clearly, since the end of the first quarter, which we all know was extremely volatile and quite difficult, unprecedented in the speed of the sell-off from historical perspectives for sure, we've seen markets really snap back quite sharply. And this is something that actually happened towards the end of March. In fact, really the market bottom was at the end of March 23rd, I believe. And since that point, equity markets have been rallying quite sharply. And we think the reason is a combination of factors. One, although now this is something that is, clearly demonstrating that it's certainly more fluid, we saw some initial success in containment efforts of the virus on a global basis, and that was something that markets were particularly paying close attention to. We've obviously been experiencing a phased and gradual reopening of economies, again on a global basis and more locally here in the US. And we've had a very supportive monetary policy, fiscal policy backdrop. And when you kind of combine those factors together, that really has helped buoy investor sentiment. And we've seen this pretty sharp snapback pretty much across the board. And so just to give you some sense of how far markets have come, at the end of the first quarter, the S&P was down almost 20 percentage points. Quarter to date through yesterday, the S&P is now up almost 19 percentage points and now down just under 5% for the year. So we're not back to the previous peak. We're about 9 percentage points off the peak, but we've come back pretty significantly, retracing a significant portion of those losses. And it's really a similar story across the board, whether you're looking at broader global equities, international markets, emerging markets. We've seen that at least partial recovery thus far. When we think about kind of where do we go from here and looking forward, we would be the first to tell you that we don't know. We don't make predictions or forecasts. However, what I would tell you is that we think the markets are going to continue to reflect this tension between really the path of the virus, and by that I mean additional cases that are diagnosed and the spread of the virus. They're going to continue to reflect that tension, combined with what I would characterize as modestly improving but still pretty bad economic data, as well as the response of our policymakers, both from a monetary perspective and a fiscal perspective. So things like the Fed, and then of course the Congress here in the US. And the degree to which markets weigh those factors differently, I think that is going to impact future returns for sure. So if the market is more focused on those pockets of positive news from a macroeconomic perspective, in an environment where, yes, maybe cases are rising, but perhaps they're not rising as much as people initially feared, that's likely going to be very positive, or at least supportive, I should say, for risk assets. Whereas if we see a situation where governments have to actually reimpose lockdowns because the spread, there's concerns about the risk of the spread getting out of control, you're likely to see markets react unfavorably. So our baseline expectation is that we're going to see a bit of a seesaw effect here. And certainly there is potential for volatility we would absolutely acknowledge until we get to the point where there's more clarity on a treatment for the virus, ideally a vaccine, and until we start to see sustained signs of general economic improvement. And that, of course, is going to be a function of the degree to which here in the US, I'll just focus here, states are able to actually reopen and ideally not have to close down again just after they're reopened. Regardless, I think it's really important if you sort of remember nothing else, this portfolio is built to handle multiple scenarios. We're not making a call one way or the other. We have a strategy that's built to give us the liquidity that you need to do the great work that you do, to make the grants that you make, and allow us to buy time and maintain our risk profile that we're targeting so that when markets do turn on a more sustained basis, we will participate fully. And I think the perfect example of that on a short-term basis, as I said at the outset, the portfolio was down on the order of 14 percentage points. We didn't, but we could have said, gosh, we're really worried about the world. And of course we were, but we could have said, we need to de-risk. That is not a long-term way to manage the portfolio. And so what we were actually doing is making sure that we had more than adequate liquidity. We met with the committee to kind of provide them the analysis that we had done to demonstrate that indeed we do. And we actually rebalanced back to our targets. And because of that, we really have been able to participate. And so when I said at the outset, this is all about a long-term view, that's what I mean. We're really trying to stick to the strategy as closely as we can. We will have pockets of volatility, that's the reality. But over the long term, if we stick to our strategy, that's how we're going to win. So with that, Alyssa, if you could go then to, actually skip past 14, let's get into more specifics on performance. So again, on page 16, on the left-hand side, you can see the asset allocation. I would note on the right-hand side, we're just showing you the change in value of the portfolio since we began managing it in August of 2016. You can see when we started working together on a discretionary basis, total assets about 64 million. We've seen a gain in the portfolio of about $26 million over that time frame through a combination of contributions from you all, which is fantastic, as well as a significant portion from performance, which is that $17 million. On an annualized basis, we're showing you the performance across the bottom of the page, calendar to date, which we spent some time talking about, as well as the 1, 3, and since inception. What I would tell you is that the absolute returns in and of themselves are quite low, but if you look at the global equity market return, you can see that it's actually similarly low, and that just gives you a sense of the market's really the opportunity set that the market has provided. And what I would note, certainly from a risk profile perspective, we're targeting roughly 70% equity market risk over the long term. And depending on the annualized period you're looking at, we've been able to achieve a bit better than that, anywhere from, call it 72% to almost 80%. of equity market upside, and certainly significantly less equity market downside, particularly in 2020. So let's go to the next page, 17. This is calendar year performance for the portfolio against benchmark. Kind of at the middle of the page, you can see the first quarter return down 14%, second quarter up just over 10%. As I said, again, in June, we think we're tracking at another 1.6, so we're getting close to 12% for the quarter to date. You know, and on an annualized basis, just over 5% since we've been working together in the portfolio. And again, as I said earlier, we're in a much better place, certainly on the year-to-date basis, than we were when we were looking at this performance at the end of the first quarter. So now if we can take a look at page 18, and we will spend some time on asset class returns. You know, this is never a fun discussion to have with anyone, let alone our clients. But just to give you a sense of just how difficult it was out there in the markets, you know, very difficult first quarter across the board for our equities. Our diversifying strategies were down, but as I said, they were only down about 36% of global equity markets, which is exactly the reason why we have them, to really try to protect the downside. And they also gave us almost 100 basis points of value added relative to the benchmark, which we were pleased to see. The one area where we had the positive performance, as you can imagine, was the treasuries. That was really the only asset class that delivered positive performance in the first quarter. Fast forward to the second quarter, page 19. It's a different story, of course. We've seen this reversal that I mentioned earlier in the market discussion. What I've been pleased to see is whereas many of the managers had a difficult, not only absolute, but relative performance experience in the first quarter, many of them have actually been able to recover in the second quarter, such that we're getting some pretty good value added on a net basis across most of the categories that you see on this page, as well as the hedge funds, again, that are up above their benchmark by over 100 basis points. So very happy to see that that has been the case, and certainly am hopeful as we move forward, to the extent we continue to see markets you know, move a bit more forward and up ideally they'll be able to continue delivering some more compelling value added. So then let's look at the page 20, if you could, Alyssa. This is since inception. You know, I would say we've had pretty good performance on an absolute basis across the public equities, particularly our U.S. equities. That's really been one of the main areas that has done quite well over this time frame. What we've been particularly pleased to see, and this is really important, is the performance of our private investments. We've been able to deliver a very attractive absolute return, to say the least, and on a relative basis added significant value against the benchmark, which is essentially a public equity benchmark. And that is important because over the long term, we are trying to get to roughly 15% exposure to these types of strategies in the portfolio. And we're doing that because of all the different types of strategies that you can invest in, we think this strategy has the highest return potential on an absolute basis, but also on a relative basis. And so as this allocation grows, it'll become that much more meaningful of a contributor to the portfolio's absolute and relative performance, and really should lift the overall performance of the portfolio more in line to where we ultimately expect it to be over the long term. So that was a bit of a mouthful. I know I'm just looking at the questions that folks had that folks had put on the chat. Has there been a discussion of socially responsible investing? And Mary, you can jump on this as well if you'd like to. I mean, what I would say is, to the extent we've had them, I wouldn't say that they have been major aspects of our agenda thus far. I think that we've probably talked about it on at certain meetings at a very high level, but we really haven't dug into that topic. It is a topic clearly that clients over time have become increasingly interested in discussing. And I would say, given everything that's been going on in the world, from a pandemic perspective, from volatility we've seen in the oil markets, social unrest, what have you, I would anticipate that clients are going to want to have more discussions around that topic and think about how it may apply to their portfolios. But what I would say is at this point thus far, we've only talked about it at a very high level and have not dug in great detail yet. Doesn't mean we can't, but we haven't. I don't know if you wanted to add anything to that, Mary. I don't want to speak out of turn.
No, I think that the way you've characterized it is accurate. I'd say that I'd also add to that the notion of mission-related investing, impact investing, and then finally investing in Montana. So high-level discussions have occurred, but I think you characterized that well, Omar. Thanks.
Thank you. So let's see here. This is cool. I get to just kind of go through the questions here on my. So what tactical tilts are you anticipating in the next year? Let's see. It would be difficult for me to answer that, maybe from the perspective that you might be coming from. When we think about tactical investing, primarily, it's not always the case, but a major determinant of it is where we think an asset's priced relative to our assessment of its fair value. And so when we think something is particularly expensive or particularly cheap, that is when we are likely to, make that tactical tilt that I referred to initially. Meaning, we may overweight a given asset class or underweight a given asset class to reflect that view. But I wouldn't be able to tell you now, looking ahead a year, how those tilts might evolve, because it's going to be wholly dependent on how markets perform and how individual asset classes perform. And then, of course, we don't know that, and we can't know that. Now, there will be opportunities to be what I would characterize perhaps not as tactical, but perhaps as more opportunistic. So you can imagine as we continue to go through this crisis, there will be, at different points in time, likely companies that are struggling for a host of different reasons. And that may create opportunities when you think about the types of investing that we might do, particularly in the private part of the portfolio, such as, for example, distressed investing. We do think that there will be some opportunities in distressed later in this segment of the market cycle that we think could become attractive. And that would be an opportunistic investment that if we do think it's attractive, we indeed would make. We will likely be spending more research time from a strategic perspective, thinking about things like, things like renewable energy, let's say, for example, that we think could become particularly more attractive in the future. Things like infrastructure. We think that is something that could become particularly interesting, perhaps later this year, or even early next, as we anticipate the government, who knows what government will have, but we do think that there's a pretty strong political appetite for things like infrastructure. So we'll be very opportunistic. We will be very well aware of the opportunities that are out there. And if we think they're particularly compelling, we will act upon them. And that's really one of the benefits of this OCIO model, is that we can do that because the committee has empowered us to make those types of decisions. All right, I'm going to keep going here. All right, how volatile is private investments versus U.S. equity? So it turns out that because of the way these investments are marked, they tend to be significantly less volatile than public equities. Particularly in significant market drawdowns, you tend to see that these investments actually hold up quite well on a relative basis. And the primary reason for that is because managers mark their portfolios extremely conservatively. And so I think of it sort of simplistically as they've marked it quite conservatively, so it has less to fall when markets go down, right? And what I would tell you, we're going to not have marks on the first quarter of private investment performance until probably the beginning part of the third quarter. but certainly our expectation is that these investments are actually going to hold up quite well in the first quarter. The second quarter remains to be seen because there's still more to happen here in the second quarter, but in the first quarter, we expect them to have held up quite well. And that's actually going to be a benefit to the portfolio on a relative basis once those marks come in. Impact investing. Hopefully we sort of addressed that within the context of socially responsible, but I would say just similarly, we've had kind of high level discussions, but we have not dug into that topic at this point in time. Doesn't mean that we can't, just that we haven't quite yet. Okay, with rates at such an extreme, are changes to the composition of the allocation to fixed income being contemplated? I would say that it's something that I think we need to do more work on. We'd be the first to tell you that it's really unattractive upside downside proposition, given the 10-year that's south of, I think, 50 or 60 basis points. However, we think about it, at least in the near term, these types of investments play an important role in the portfolio. Even at the yields that they are at right now, they can still provide some cushion if we see additional weakness in the market. And I would also note that relative to rates that we can get elsewhere, meaning other types of global bonds, it's still the least dirty shirt is the way that I would characterize it. So it's not that we are not open to thinking about the alternatives, but I would tell you at this point in time, unless we're thinking about increasing the risk profile or changing the risk profile of these investments, it may be, at least for the foreseeable future, that there are few very palatable alternatives. In any case, I do think it's something that we're going to spend some more time thinking about. But even, when we started the year, rates were incredibly low. No one thought that they could go lower, and indeed they did. And these investments perform their role. If we do see additional weakness, we would expect them to continue to perform their role. Maybe they don't give us nearly as much upside, but we don't necessarily expect them to depreciate. And so they're going to have value as a shock absorber in the portfolio. So I would say, near term, we don't anticipate making any changes in that part of the allocation. Perhaps intermediate term, it's something that we're going to continue to think more about. Let's see here. How do I define off-the-shelf investments? So this would be, an investment management firm or a big bank that, not only offers portfolio management services, but also then kind of allocates their portfolio management services to their own products. And so while they may not necessarily have to charge fees for those products, there's ways to kind of hide the true cost of those investments to clients. We don't have any of those types of products. We don't have any proprietary products that we are trying to market to our clients. We work with external investment managers. We have no sort of financial relationship with those external investment managers. And so we think that makes us much less conflicted than many that we see in the industry. And we think that's important. Let's see here. How do we feel about the private equity premium for liquidity going forward? We think it's still there. If that is sort of the, kind of the driver of the question, is it what it was 20 years ago, 15 years ago? Perhaps not, but we still think there's a premium there. We typically try to target, or our goal in making these investments is to try to get about 300 basis points of value added above what we could get from public equity markets. We still strongly believe that we can get that. We've certainly been able to deliver it for the foundation as well as our other clients. And we think we're going to continue to be able to do that by being very selective in the types of strategies that we look at. We are not looking at the big mega cap buyout funds that are paying, or it had been paying at least, at the end of last year, multiples that you would kind of say were very comparable to the dot-com bubble and bust. We're looking at smaller segments of the market where we still think that we can get competitive pricing. We're being very opportunistic with the types of strategies where we think the return potential is still there. And if we can do that and be disciplined with that, we do think that we'll get paid to hold these investments. And certainly if we didn't, we would not be doing it because it's obviously not worth the illiquidity. But we think our track record, both for the foundation and the track record that we've been able to deliver to our clients really demonstrates the value added potential of these investments. And we expect that largely to be maintained going forward, given the approach that we're taking. What opportunities do donors have to input into MCF's investment philosophy? Mary, I'm going to ask you to chime in on that one.
Can you hear me? Good to
Yes.
go. So I would say if you have opinions or feelings or thoughts about that, you can certainly reach out to me, and then we can either connect you with the chair of our investment committee, or happy to have a conversation with you about that. So just reach out directly. We'd be happy to talk about it. Thanks.
Great. Thank you. Let's see here. Okay. When you say your target to equities is 70%, how do you count private equity into this? Is the dollar amount of private equity counted as more than a dollar of public equity, i.e. potentially reflect leverage when present? So let's see. Long term, when we think about the return expectation from this portfolio, we are targeting ideally better, but at a minimum, we're targeting roughly 70% of what we think we could get from global equity markets. So over the long term, if we think global equities on a nominal basis are maybe going to give us, just to make things simple, 10%, long term, we would expect this portfolio to give us roughly 7%, given the makeup of the portfolio across the public equities, the private investments, and the other strategies that we have in the portfolio. You know, hopefully, the goal is by making these private investments that we're making, we can do better than that, because we think there is greater return potential there. But in terms of what we try to target and what we try to manage to, I'm always looking at the equity market risk that we're modeling from the portfolio. And if I see something that is a bit north of 70%, you know, that's something that we try to manage back down to that roughly 70% equity market risk profile. And that's really, when I talk about the risk profile, that's really what I mean. It's less necessarily related to the private equity and more the overall return that we're targeting from this portfolio is how I tend to think about it. Let's see. Are you concerned with growing national debt and how it will affect the various markets? Yes, I am. I think we all should be. But it's really a difficult question to answer from the standpoint that it's one of those things that certainly long-term, I think could be a major issue. In the near term, do I think it's as big of an issue despite the massive stimulus that we put into the system and despite the record amount of treasuries that have been issued to try to soften the economic blow? I'm less concerned about it in the near term because I just don't think there was any alternative. And by the way, most other major governments also similarly have issued massive amounts of debt to try to address this issue. Longer term, yes, I think it could be a major issue and likely will have major ramifications for the market. But I don't think we're there yet. And I think it's honestly something that, you know, we're going to have to spend a lot more time on, not just as a team, but just as a country, thinking about what the implications are and how we might address it. But certainly in the near term, it's just something that I think governments had to do to try to make the situation less awful than it potentially could have been. And I think, you know, we'll just have to spend more time looking forward on what those potential implications might be. And then I think I may have missed a question, and I apologize. What types of investments are you considering as private investments? So this would be things like buyout strategies, venture capital, growth equity, where the manager is providing growth capital to the firm to really try to take them from a small company to perhaps a medium-sized company. You know, the venture capital is typically more technology focused, a couple of people in a garage with an idea, high risk, high return proposition, but really can be a particularly important driver of the returns of these investments over time. You know, buyout, taking a company private, improving the operations of that company, streamlining operations, processes, et cetera, and then taking that company public again. We can look at distressed assets that would likely be in a liquid structure. there may be some more real assets oriented strategies. As I mentioned, you know, things like renewable energy is probably something that we're going to take a look at in a private illiquid structure. Those are the types of strategies that I'm referring to when we speak about private investments.
Right. Thank you, Omar, and thank you to everybody for your wonderful questions. As mentioned at the beginning, there will be a recording of this webinar available on our website at mtcf.org/webinars. And we will also be sending out a copy of this recording to all of you on the call and all those who registered. Also just want to let you know, if you leave this and have some questions, we are always happy to get you answers. So feel free to reach out to me directly with any questions that come up, as well as Mary is available. And just thank you so much for being our partner in philanthropy. And yeah, we just hope you have a good rest of the day.
And thank you all. This has been great. I very much appreciate the opportunity. We very much value the relationship, and I absolutely look forward to getting back to your neck of the woods at some point in the future, because it's awesome out there. So, you know, I don't know when, but I know it will happen.
Thank you, Omar and Alyssa. Take care.
Thank you.